Hello and welcome to the Friday edition of the Sharesify podcast. James and Steve are here. As always, how are you guys?
Hey, Ian.
Okay.
And not much to say this week in terms of market action. It's really all been about US tech. So, Steve, take it away. What's been going on?
Well, of course, the big story and listeners is Nvidia had results this week, but we'll come on to that. We'll look at that in a bit more depth down the line. But there was also very decent results from Autodesk, but they struggled with guidance. CrowdStrike, a very different kettle of fish. Very much pleased the markets. Shares jumped about 9-10%. And it's one of those really highly rated P's up about 120 times or something like that. So it's really a case of it's got to keep growing really rapidly and keep beating forecasts and raising guidance. But so far, so good. And then we've had Intuit as well, an older fashioned software name. It's a kind of a peer of the UK listed Sage. It's known for its QuickBooks and TurboTax is better known in the US. Again, struggling really, I think, to just capture the imagination. Growth is looking a little bit soggy at the moment. So we'll see whether or not that perks up in terms of share price as the year progresses, if they can start sending more positive messages. But you were talking, chaps, about to Richard Stone on the pod as well, weren't you? So that's sounding quite interesting.
Yeah,
Yeah,
great
absolutely.
pod.
Yeah,
Great pod
yeah, we
yesterday,
hosted him.
Steve.
Yeah, we hosted him, didn't we? And Richard Stone from the AIC. He talked about how trust can increase their appeal to investors and what to expect at their upcoming investment company showcase. That was really interesting.
Yeah, very much. And you've written a piece on value trust this week, James.
Yeah, that's right. On the site, so it's a piece looking at the various value-oriented trusts, their different strategies for bagging bargains, and we sort of delve into some of the stocks they've been buying recently. So, I'd urge listeners to go and take a look at that. Also,
Mm.
in the trust world, some interesting results today. CT Private Equity Trust. So a bit of a subdued first half with a NAV decline, but there's a few things going on beneath the surface. So recent sales of portfolio companies have been at premiums to carrying value, which is encouraging. And the chairman's seen signs of recovery in the PE market. So that could be one to watch.
It's been a really interesting space this year, isn't it? Private equity, because there's been so much noise about big IPO, SpaceX first, potentially Anthropic and OpenAI. So there's been this big draw to for investors to find these private equity trusts to access these companies before they actually come to public markets. But it's a really split, mixed, reaction. Some have really done well out of it. Some have really struggled. So there really is a dichotomy in terms of the performance.
Yeah, and James, because you'd looked at literacy earlier in the week, hadn't you? And again, that's another one that has sort of stakes in small businesses and privately held assets and so on.
Yeah, we got a story on the site on that one. That's very interesting. It's got that unique charitable mission as well. So
Yeah,
donating a proportion of NAV each year to literacy charities. So take a look at that.
yeah.
James, you've been getting on your bike as well at Halfords, haven't you?
Yeah, I have indeed. I've been driving the upgrade there at Halford. So heat
Oh,
waves,
yes.
yeah, have driven demand for bikes, camping equipment, and various air conditioning services. So, but the thing with Halfords, I've followed this for years, very weather sensitive, a track record of downgrades. It's now in an upgrade cycle, but of course now it's set quite a high bar for next summer's trading comp. So I'd be a bit wary of that one. But yeah, having a good run.
I've been in there a couple of times this summer, actually, to be fair. A few little
Yeah.
bits and pieces. Got a visory on the old MOT, so I had to nip in and get a wiper and various other bits and bobs.
Yeah, yeah. Well, you don't really want to be too reliant on on the British summertime, though. I mean, we've had pretty consistent summers over the last few years, but I certainly want to be beholden to another scorching British summertime next year.
Oh, no, absolutely. A
And you've
couple
been
of
looking
things.
at an engineering firm, Ian.
Well, Steve, it's funnily enough, this came up in conversation on Wednesday when we talked about MS International, and I was saying, oh, it's a multi-bagger like Goodwin. Well, blow me.
Right.
Today, Goodwin's come out with a more than doubling of profits in the past year, and this is as I say, it's a multi-bagger. It's up something like 550% in the last 5 years. It's an engineering business, but it's strange, a bit like MS International, where they got their forecourt business. I mean, the majority of the business at Goodwin is good old-fashioned heavy engineering stuff. Some of the businesses go back to the 1880s, and it's used in power stations. It's used in the defense industry. and a huge, great pumps. I mean, some of these things are like 40 tons. So it's a real specialist forgings business and castings business and so on. And but it has another business that's refractory that makes stuff for the jewelry industry. And the thing is, they've more than doubled profits in the year to April. That's fantastic. But you can't extrapolate that because they've said they're going to sell the engineering business. This is 75% of sales and 85% of profits. So you're going to be left. I mean, the good news is the shares popped today. They went up 10% at the open. They're now up 5% because I think people are sort of asking themselves, that's all well and good. Sell the engineering business, return the cash to investors. What are we going to be left with?
Yeah.
You're left with this refractory business where sales just about grew last year and trading profit was up 15%, whereas for the group it more than doubled. So all the heavy lifting has been done by engineering, and
it certainly
for
sounds
sale.
like it sounds like an archetypal special situation, I suppose, at this point in time. But you and your canaries in the coal mine, you looked down the small cap ladder earlier this week, didn't you, as well? WJG, remind us who they are.
So Watkin Jones, yeah, they're a buy to rent developer, and they don't sell to people like you and me. They sell to investors, people who want to buy in bulk. And so they've just done two developments. Not just, but when they've completed two developments quite recently, Cardiff and Bristol, about 1,300 properties. Problem is, investors aren't biting. They thought that by the end of their financial year, which ends in September, they thought they had signed a few deals and there'd be a bit of a recovery in profit. So sort of to recap, 2024, profit was about 10 million, 10.5 million pounds. 2025, it dropped to about 6.5 million. They thought it would recover this year because they only made 500,000 or so in the first half. Now they're saying there's going to be no profit in the second half at all.
Yeah.
So it's interesting. I don't quite know what the read is, but investors like buy to rent.
Yeah,
I'm
guessing. I mean,
signing the
you've
deals.
got the interest rate cycle, and it seems to have flatlined. So the rates have not come down quite as expected, which is obviously going to affect the market. But also, I think yields must have come into question because there have been new rights for tenants, etc., etc. So that must have also affected the security of income and the security for landlords to be able to raise prices. So there's quite a lot of kind of macro themes going on in that wider space as well, aren't there?
Yeah, they say the appetite's there. They say they're disappointed that investors haven't signed off on these contracts, which they thought they would have done by the end of September. So, yeah, quite a disappointment.
Okay, but before we crack on to take a look at next week, let's just have a bit of a deep dive into Nvidia. So this is our regular feature. So this the share of the week, and I think that the key thing is they had the Q2 results. Financial year 2027, its full year end is January, remember. So second quarter results, they were knockout, absolutely knockout. The shares reacted after hours by jumping about 6%. By the end of Thursday's trading session, they've captured almost a 9% gain. Now that's pretty astonishing for a $5 trillion plus company, the biggest company in the world. I think the key message in here is that investors are bought into is that Nvidia has long since moved from being purely a GPU producer. It's all about now the whole ecosystem about networking solutions, software solutions, NPUs, CPUs, and much more AI infrastructure. And I think that's the story now that investors are starting to really get behind, and that's why the share price really bounced quite aggressively. There are risks, of course, associated with the stock. Its rating, that's traditionally been the big question mark. But let's look at the rating. The valuation of the business at current levels is on a PE below 20 times. Now, just to put that into a context, you'll pay more than that for a Walmart. You'll pay more than that for a Coca-Cola. So it's really about understanding how rapidly earnings have grown over multiple quarters now. This is not running out of juice. And the commentary from CEO Jensen Huang is very much about our guidance is accelerating. So estimates for the third quarter were raised again. I think we were looking for something like 104 billion in revenue, and it's going to be about 108 billion revenue. So these are significant moves forward on already high expectations. So of course the question is always going to be, how long can it continue growing at this kind of rate? And that's, one of those classic questions: how long's a piece of string? Presumably at some point in the future, AI spending taps will have to start being turned down a bit. But there is absolutely no sign of that from all the leaders at the moment. It's just very, very much gung ho and very much about now. We are showing you real profits, real revenues, and real cash flows from the investments we are making. And I think investors are really starting to see great opportunities for these companies that have done spectacularly well, but could still do spectacularly well further down the line. So it's a really financially strong business. You're talking about gross margins of 75% odd, operating margins around 60%, quite astonishing. Return on capital employed, this is running at 60 odd percent. I mean, these are unprecedented numbers, and for a company of that kind of scale. So Nvidia really is worth taking a look at, given the recent news, given the recent share price reaction, but look at what the expectations are and look at what that valuation is, because you might find it's nowhere near as expensive as you might presume. Okay, let's turn to next week. Ian, what have you been looking at next week? One of your dull but really valuable companies, isn't it?
Delightfully dull, highly predictable, Steve. You could almost say, in tribute to Dolly, it's a 9 to 5. It's Bunzl, which distributes food packaging, disposable products, cleaning, hygiene stuff, and so on. Main customer base is food service industry, firms like Compass and Sodexo, catering firms, and the supermarket groups, grocery business. So it just sells, every week tens and tens of thousands of little low cost, low value things that really matter to the industry, bits of packaging, bits of, food service industry, so napkins, plastic knives and forks and all that sort of stuff. Doesn't grow particularly fast, about 3% underlying. They usually, at the sales line, they usually add about 1% in or get acquisition led growth. So you kind of got 4%, maybe 5% top line growth, but it's super efficient and generally earnings sort of compound at a double-digit rate. It's been a great performer. It's been a big market favourite with people. That's out on first half numbers out on Tuesday.
Because presumably it's also got a dividend story to it as well, so that total return will outshine its share price returns.
Yeah, it's just mainly the fact that it's just no frills, sleep at night kind of stock, basically. That it has been more about the capital appreciation, in fairness, than the dividends, because it just bangs in the numbers. As I say, it's really dependable.
James, you've got time in your hands. You're looking at something applicable.
Yeah, Watches of Switzerland, so clocked up some strong gains this year. I think, they've got the Q1 update next week. I've got a sneaky suspicion they might upgrade guidance, but given the kind of resilience of the US market and with the UK showing some signs of improvement. But if you want a bit more on kind of the watches sector and luxury more generally, check out our recent podcast with Deborah Aitken from Bloomberg Intelligence, which had some really fascinating insights on there.
Yeah, really good point there. A good reminder to listeners that we have this growing stash of podcasts with all sorts of fund managers, analysts, all professionals, experts in the investment world, and they really can deliver some insightful thought pieces. Just to wrap up and look ahead. So this week, of course, we had Nvidia. Next week, we've got Broadcom, which is probably the number 2 AI play outside of Nvidia at this point in time. So James is just talking about guidance. They might raise guidance at Watches of Switzerland. Well, if Broadcom doesn't raise guidance, I think investors are going to be asking why the hell not. It's kind of factored in that they not only beat, but they move guidance up. They need to be talking about AI capex taps are very much open. They're not being turned down. They're not slowing down. I guess that will probably be the tone they set, but the nuances of the commentary from the CEO, CFO will be really valuable to listen to. So the great thing about some of these big US companies is you can nearly always download the the analyst calls after the event as well, and the presentations. So check out their IR site after they've announced next Wednesday after hours. So I guess, guys, that's about it for this week. It's been a pretty hectic week given the fact that we're in the middle of August, but more of the same next week. We'll have a bank holiday on Monday, so we won't be in the chair on Monday, but we'll see you next Wednesday on the pod, and keep coming to the site and check us out.
Yeah, bye for now.
Take care.